we're seeing some buying when it comes to the tech names, thanks to something we're going to be talking about a little later. Those chip stocks higher for a pretty good reason. But other than that, investors kind of shrugging off this inflation print.
They're shrugging off the inflation print. And also, amidst all of the noise here when it comes to earnings, we have the S&P 500 basically flat right now.
Hey, we're going to have much more on the markets in just a second with Charlie Pellet. In the meantime, big banks is certainly our focus. Half of them have reported. We've got the good, the bad, and I don't know, maybe we can say the ugly.
And a great day for chips, specifically Nvidia and AMD. We have Ian King on the dramatic reversal of the Trump administration.
Also, speaking of AI, we're on the ground at the inaugural Pennsylvania Energy and Innovation Summit as President Trump makes his way there to Pittsburgh. We're going to hear an update from Tyler Kendall in just a few minutes. In the meantime, a check on the day's trade and top business stories. Here he is, Charlie Pellet.
Thank you very much. And here's what's going on. We've got the Dow, the S&P lower, a whole lot of nothing, as you guys said, on the S&P right now, down 262.65, drop there of under 0.1%. Earlier in the session, though, we did see the S&P rally to 6,300 before retreating. The NASDAQ Composite Index up 145 right now. For NASDAQ, that is a gain of just about 0.7%. We got NASDAQ getting a lift, NASDAQ 100 as well from those chip names specifically. AMD, Advanced Micro Devices, and Nvidia. Nvidia right now up by 4.1%. Big member of the Mag 7 Index, the Bloomberg Mag 7 Index up by 1%. The 10-year, 4.48%. CPI Tuesday, we got the PPI tomorrow. The 2-year, 3.95%. The 30-year, 5.01%. Gold down $15 the ounce, 33.28, down 0.5%, and West Texas Intermediate crude down 0.9%, 66.39 a barrel. Bitcoin right now down 2.4%, 117,291 on Bitcoin. Earnings news, specifically big banks. We'll have more coming up in a moment, but JPMorgan Chase now down by 0.9%. Citigroup surging 3.3%. Wells Fargo now down by 6.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. You heard some numbers there from Charlie. Worth repeating a couple of the reasons behind some of these big bank moves today. JPMorgan Chase's investment bankers eked out a surprise gain in the second quarter. It signaled what may be the start of a deal-making rebound after widespread hesitation tied to U.S. tariff policies. Wells Fargo shares falling, down now by 6.7%. The bank reported net interest income for the second quarter that missed the average analyst estimate. And Citigroup reported solid beats on FICC and equity trading revenue. The bank also said that it would ramp up stock buybacks following a strong result in regulatory stress tests. Citi shares up 3.3% right now. Let's get to it with Sri Natarajan, Bloomberg News chief Wall Street correspondent, Shali Basak, Bloomberg News and global finance correspondent. They both join us here in the Bloomberg Business Week studio. Sri, where do you want to start?
Well, let's start at Wells Fargo because that is the most striking number coming out of the results this morning. The stock is down 6.7%. If that holds going into end of day, that would be the worst performance for the bank stock on earnings days going back at least 4 years. And it is a surprise because we're coming to this news on the back of the June announcement from the Fed that said the asset cap that had been placed on Wells Fargo has been lifted. The bank is finally unshackled. So perhaps investors and analysts were heading into this earnings day call expecting some big announcements from the bank, expecting some big growth outlook. Charlie Scharf, the CEO, has repeatedly said that just because the asset cap has gone doesn't mean our strategy changes overnight. It's not like flipping a switch. It gives them the firepower to invest and grow in various areas, and they've identified a few key spots, but you won't see immediate results. And the second quarter results kind of bear that out. They cut their NII guidance. Their expenses for the full year are likely to be higher than what analysts expected. Combine that with all the optimism, the excitement with which investors headed into the day. The result is you get a stock that's down 6.7% with about 2 hours of trading left.
Shonali, Citi is a different story here because that stock is rising to its highest level since 2008. We know that that's on this stock buyback plan, but just walk us through what stood out to you on those Citi results.
Right. You have Citigroup trying to get to their return on tangible common equity targets of 10 to 11%. And Jane Fraser, the CEO, said it'll take a minute to get there. But of course, improving profitability is a huge part of this story. Citigroup still trades at less than tangible book value. So people are waiting for it to get to par. This is the idea to get there. So they were the cheapest among the banks. I think that this is really interesting. If you look at the price to tangible book values of the banks today, it will show you the types of businesses that Wall Street is really betting on. Sridhar, Morgan Stanley is more valuable today than JPMorgan. I think that is a fascinating statistic here because it shows you that the more Wall Street weighted banks, and by the way, Citigroup is showing that it could fire on cylinders of those Wall Street businesses, trading, investment banking. They've been gaining some share. This is surprising. They brought in a lot of new stars to do this. There were doubts when those people came in, and they're showing you that they're coming in to take some business, right?
Yeah, well, let me give you a quick counter to that. Yes, price to book, price to tangible book, they might be better than JPMorgan, but that doesn't mean necessarily that they're more valuable than JPMorgan. The piece of the business that they're in is clearly favored by investors, favored by analysts, and the fact that you have a market out there that appreciates consistent fee-based revenue growth. But to be a giant bank, to be a behemoth like JPMorgan, you have to have a big presence in the consumer economy. You have to have a big presence in all of Wall Street's chief operations, and JPMorgan has that.
Okay, fine.
Which
King
is
of the
why
castle,
it is a giant
King of the castle.
by a
It's
mile.
the bigger Morgan, but it is still interesting that today, at least on that multiple.
That I will give you.
Yes. I told you we would make this fun for you.
Are you guys done? Or are you gonna keep?
We're like a brother-sister pair.
I love this. I love this.
Can I set him off once more?
I will ask you to do that in just a minute. In the meantime, you guys mentioned JP Morgan, so I want to bring in some commentary from JP Morgan that you highlighted, Shonali. Quote, the U.S. economy remained resilient in the quarter. The finalization of tax reform and potential deregulation are positive for the economic outlook. However, significant risks persist, including from tariffs and trade uncertainty, worsening geopolitical conditions, high fiscal deficits, and elevated asset prices. Shri, we look to Jamie Dimon. A lot of investors look to Jamie Dimon as sort of a weatherman when it comes to taking the temperature of the economy. What was the takeaway from him today?
Look, I know we like to compare him to a weatherman, and he also loves his there are dark clouds on the horizon analogies. But to be fair, he's not a great weatherman, because a weatherman has to tell you whether the weather is going to be good or bad today and tomorrow and day after tomorrow. What Jamie Dimon has consistently pointed out with respect to risks in the system, the geopolitical tension, the risk of extensive borrowing by the US government, these are not problems that are going to torpedo the system tomorrow or next quarter. These are long-term problems. And Jamie Dimon is right to express those as real concerns that exist in the system. But that's not something that investors are too fussed about right now when they're trying to analyze this quarter versus next quarter and the coming few quarters. So you go back to the first part of that statement where he did express optimism, and that's what takes you back to the environment we're in for the biggest banks right now. Tax regulation, tax cuts, deregulation. These have been crystallized with the bills that have been passed in Congress. That means there's a very clear runway for banks to see catalysts for growth. And as we get to the other side of the trade policy and the tariff uncertainty, you will also see that element of when all of these people were talking back in Q1 about clients and investors and companies tapping the brakes, not slamming the brakes, which effectively means the car is still running. And now they can accelerate as they get more clarity. So even parts of the business that had been lagging a little bit, like deal making, can rev on all cylinders. And that only means good things for the biggest banks that have also effectively attached to themselves to the highest end of the US economy. So even if you start seeing some worsening in the broader consumer economy in the lower segments, that is not really affecting these biggest banks just yet.
Shonali, I'm wondering if we could bring you in here in terms of the increase in deal making that we did see this quarter. What was really driving that? Is that coming from the Trump administration being maybe a little bit looser when it comes to some regulations, or was it just a natural push of the economic cycle?
It's a great question. I have numbers for you. So the deal flow in the second quarter, according to Bloomberg's data, this is mergers and acquisition alone, we're up by 16% roughly. For the first half of the year, it's up by 23%. Now, last year was a dog, right? Nothing was happening, nothing good. And in fact, if you look at this year, you have a lot of deal activity that's still on the sidelines. At the same time, I stole this from the bank that Sridhar used to cover so closely, Goldman Sachs. You have an institutional loan market that is about $1.5 trillion overall. By comparison, the private credit market is $1.7 trillion. And so you have these banks fighting now for more share in that lending market because private credit now is actually bigger than the institutional loan market. And so you had overnight, you've got to love a good announcement the night before earnings when JPMorgan comes out and says that they're going to organize a team to do more public-private markets activity. So yeah, things are coming back. They're not booming back. Mm-hmm. And remember, some of the stuff that we're seeing out there is kind of frothy, right? It's SPAC deals and Bitcoin treasury deals and IPOs of crypto companies. So there are deals coming back. We spoke to Kristen Roth-Clark a little earlier today at Barclays, a tech banker there. They see a lot more in terms of IPO activity, but this is not a gangbusters year. And in fact, if the numbers that I've given you, JP Morgan's jump in investment banking activity trailed those numbers. So the idea is that it'll catch up as the pipeline could potentially grow.
Sonali Basak, Bloomberg News, global finance correspondent. You've been here since 5 a.m. You got to go. Shri, we're going to keep you for another minute because we're going to look ahead to what we have coming up tomorrow. Bank of America, Morgan Stanley, and Goldman Sachs. Big picture. I want to start with Bank of America because we get such a good outlook on the economy from Brian Moynihan. What are you expecting from Bank of America?
Again, you will hear some of the same things that you heard from people like Jamie Dimon and Jane Fraser today, which is it's a resilient economy out there. The consumers are fine. The consumers are being discerning. The consumers are disciplined. But the challenge when you try and decipher these announcements and these statements is these executives and these banks in particular they will also tout the fact that they serve the more affluent customers. Their portfolio is made of more prime customers than subprime customers. And if there is any weakening in the economy, it probably the cracks start appearing in the subprime segment that these banks don't necessarily serve, which is why if you even compare the performance of the biggest bank stocks versus, say, the regional banking index, you will see a bit of a disparity. And that is interesting. But as you sort of wake up tomorrow and hear Brian Moynihan and hear other Bank of America executives, you will, in all likelihood, see a repeat of the sentiment that's already been expressed today, which is even if consumers say they're uncertain about the future, it's not really being reflected in their actions just yet.
Okay, Shri, you got to go home and get some sleep also because you've been here since the wee hours this morning. Shri Natarajan, Bloomberg News Chief Wall Street correspondent, joining us here in the Bloomberg Business Week studio. So that's a look at three of the big banks, which we're interested in not just for their results, but also for their macro commentary. Jayati Bardwaj is also watching this commentary closely. She's director in FX and EM strategy at TD Securities. She joins us here in the Bloomberg Business Week studio. I want to shift gears a little bit and talk capital flows because that's certainly under your purview. In this new tariff regime, we've got a great story on the Bloomberg about the maker of Kerrygold butter, a favorite of pretty much everybody, has slowed its U.S. investment as it waits for more clarity on President Trump's trade settlement with the EU. Just about an hour ago, we heard from Embraer's CEO. He said he may revisit its business plan due to U.S. tariffs. It's an evolving situation, certainly, but how do you see tariffs changing the flow of capital, big picture?
I think the biggest thing is that they have injected a lot of uncertainty into markets. And I think last week was that wake-up call because markets had become a little too sanguine on tariff risks. And we came back with multiple letters and that uncertainty crept back up. And that's why the dollar is getting the bounce that we're seeing. You're also seeing the change in capital allocation, which you rightly mentioned. The biggest mover and the first mover actually has been Europe because they have been very quick to repatriate and they've been very quick to, bring money back home into local equities, which is actually what's boosting the currency at this point.
I want to jump in because as I was asking you that question, we got a red headline crossing the Bloomberg terminal. The president says that Indonesia will buy 50 Boeing jets in a trade deal. How do you look at a U.S. manufacturer, a massive U.S. manufacturer, as a bargaining chip when it comes to these negotiations?
The thing is we've seen with Trump is that we've seen a lot of frameworks or skeletons of a trade deal. But right now, we're still figuring out a lot of the specifics. Even with the UK, we don't know what the specifics are. That's why markets are in a very uncertain mode. That's why you've not seen markets rally on all of these trade deals the way you would expect otherwise. There's still a lot of uncertainty, especially to the degree that tariffs are being used as leverage to extract a lot of concessions from the rest of the world. The one interesting headline which came out a few days ago is that the European Union is now talking to its other non-US trading partners to come up with a joint trading alliance and take a stronger stance to the US. I think those are also the things which are interesting, because while the US is a very strong dominant power in the geopolitical space, it is actually forcing the rest of the countries to step up and do a lot more fiscal spending and also a lot more trade amongst themselves.
Let's zoom out and talk about how all of that impacts the direction of the dollar. We've seen a lot of weakness this year when it comes to the dollar. What do you see the catalysts next, at least for the direction of dollar strength right now?
I would say that in the very short term, I think there's going to be a tug of war between just short-term technicals, which tell you that the dollar is very cheap from any historical standpoint, which is why you will see some times when the dollar is trying to bounce back higher. But structurally, I think this is as convincing a time to sell the dollar for more structural reasons than you would have received. For the longest time, everyone would tell you that the dollar is overvalued, but you could never come up with good enough reasons or catalysts for that dollar, weakness to sustain. But after a very long time, I can now come up with a lot of reasons for why the dollar, weakness will sustain unidirectionally in the remainder of the year. The capital allocation, that's definitely one which we've seen in Europe. It remains to be seen if other countries follow. But another very interesting bit is that the global investors of the world have been overweight US equities, but they were actually doing that unhedged. They were not hedging their currency risk at all, because the dollar would rally and give their portfolio a boost. But that's changing, and that's why the dollar is structurally seeing that pressure downwards.
What about the Fed here? If we only get one cut this year, does that change the calculus of just how much we see the dollar weaken for the rest of the year?
Not a whole lot, because actually what's interesting is that the correlation between US rates and the dollar has actually been broken. The correlation between the US dollar and a lot of factors are broken. You would see yields have backed up, commodity prices have backed up, equities have backed up, but the dollar is the only asset class unidirectionally heading lower. So that correlation, which you rightly pointed out, would have been very strong at one point. It does not matter anymore, because the structural factors at play are proving to be stronger, a lot more than this correlation to rates.
JT, what happens to the value of the dollar if Fed Chair Powell is somehow ousted?
It is definitely a question we've been discussing a lot, and it's definitely topical with all the headlines. There are a lot of questions around the legality of all of this, but it definitely is. The more conversation we're having about this, the more I think it's edging dollar into emerging market playbook. It's daily
from the president.
Yes, I think it will definitely be injecting a lot of risk premia into markets. And I think even Besant and Trump are careful about that. That's why whenever they're asked, straight up, are you going to fire Powell? Till date, they've said no, because they know that the minute that answer shifts to yes, markets will, price in, Treasury is going to sell off, and the dollar is also going to massively sell off.
So is the dollar a bigger guardrail, or is our Treasuries a bigger guardrail?
Treasuries are a bigger guardrail, because till date, we've not seen any active signs of investors selling Treasuries. So that has still been intact, with Treasuries being the global safe haven of the world. The dollar correlation is already, it's scraping away already. So I think Treasuries is still the more intact one, which I think you need to preserve. And I think that's why Besant and Trump have been very guarded in their comments about Powell today.
JT Bardwaj, always good to see you. Thanks for joining us on Bloomberg Business Week Daily, Director in FX and EM Strategy over at TD Securities. Coming up next, we're going to take you to Pittsburgh to a major summit on energy and AI. In fact, the president is on his way there right now. That's next on Bloomberg Business Week Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P 500 index flat on the day right now. CPI Tuesday, the Dow lower, NASDAQ Composite Index pushing higher. Relatively tame inflation data failed to ease Wall Street's worries about the impacts of tariffs. Initial rallies in stocks and bonds sputtering on bets that the Fed will keep rates on hold for now. At one point this morning, we did see the S&P 500 index briefly touch 6,300. So again, the S&P S&P 500 index unchanged on the day. The Dow down 302, now down 0.7. NASDAQ up 153, a gain there of 0.7%. 10-year at 4.48%, with the 2-year 3.95%, the 30-year 5.01%. Gold down 0.5%, 33.26 the ounce, and West Texas Intermediate crude down 0.7, 66.52 for a barrel of WTI, and Bitcoin down 2.5%, 117,230 on Bitcoin. President Trump says Indonesia has committed to purchasing $15 billion in U.S. energy, $4.5 billion in American agricultural products, and 50 Boeing jets. That according to a post on Truth Social. Recapping, S&P 500 index little changed, up by 0.5 point. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. In a little over an hour, President Trump will tout $70 billion in AI intelligence and energy investments at the inaugural Pennsylvania Energy and Innovation event in Pittsburgh, along with key members of his cabinet, Energy Secretary Chris Wright, White House AI and crypto czar David Sachs, EPA Administrator Lee Zeldin, and more. We'll also hear from CEOs of major companies in the AI space, including CoreWeave and Anthropic. Those folks are expected to attend, too. The president on his way there now. Also there, Bloomberg News White House correspondent Tyler Kendall. She's on location at Carnegie Mellon University in Pennsylvania. She's been there all day. Tyler, when we think of Pennsylvania, we often think about steel and traditional blue-collar jobs. Is this the start of a new economic paradigm?
Yeah, hey, Tim. Well, the state and the senator that's throwing this, Dave McCormick, would certainly like to think so, having this be in Pittsburgh and at the center of this. I would also point out that another part of this summit, yes, we're talking about artificial intelligence, but we're also really talking about the energy that's needed to power it. And Pennsylvania is the second largest oil-producing state after Texas. And there really does seem to be a focus here on how there can be this combination between AI innovation, but also energy production that's needed in order to power it. Now, you mentioned there at the top that President Trump is about to come here, speak, and talk about investments. We actually got an updated number from Dave McCormick's office. The number is now $90 billion worth of private sector investments that are going to span a range of things. We're talking about data centers. We're talking about updating infrastructure, which is, of course, very important in this. But we're also talking about perhaps some changes in the workforce, this idea that there could be new training or AI apprenticeships in order to get the AI economy up and running in a way that this administration at least says they want to make sure they can maintain in order to keep that edge when it comes to the competition with China.
Tyler, like Tim said, there are going to be a number of AI CEOs in attendance at this meeting. Who exactly is going to be there? What does it signal about who's winning from these potential investments?
So there's a range of CEOs that are going to be here. Some are coming from this point that they are pledging these investments. For example, Bloomberg News reporting that Blackstone is going to pledge $25 billion when it comes to investing in AI data centers and infrastructures. And then we're seeing some of the innovators in the space here, like CoreWeave, Anthropic, companies like that are trying to make the case that they are staying ahead and maintaining this edge when it does come to innovation. We heard a really big announcement yesterday from Mark Zuckerberg when it comes to Meta, and a huge pledge to invest in data centers going forward. It's actually something that I asked the Energy Secretary about, Christopher Wright, earlier, because when you do have such big investments, that does bring us back to this idea about energy and whether or not the U.S. has a capacity to fulfill some of these really lofty goals. He ultimately said that he thinks that we do, but it's going to be a tough challenge, and it's one that they realize isn't going to come so easy, and that's going to take a confluence of different sorts of events. Mainly, when you ask the administration, that's all about their deregulation agenda.
You know, what's also interesting here is that how is the U.S. really going to be investing in data centers when there are tariffs on materials, think copper, that are required to power these data centers and to require to make more energy infrastructure in the U.S.?
Right, that's a really great point. It's actually one of the questions that I posed directly to the U.S. Energy Secretary when we have 50% copper tariffs expected to go into effect on August 1st. And we know that materials like this are really important for AI data centers, but then I'd also point you to those steel tariffs. And we're starting to hear the industry really talk about this idea that they want carve-outs, even if it's a short-term carve-out, so then they can let production reshore to the United States. As you're about to hear, I think we have the bite. I did ask the Treasury Secretary specifically if carve-outs are on the table, and here's what he told me.
I believe the president plans no special carve-outs. He wants to reindustrialize the United States of America. There's a lot of tools to do that. Make it easy to invest in the United States, make it attractive to invest in the United States, and tariffs are an additional element of that toolbox.
Tim and Emily, that's probably not too welcome news when we are talking to industry officials. Like I sat down with the head of the American Petroleum Institute who told me that they're in active discussions trying to get some sort of exemption here. And often we hear this pitch from industry that perhaps there could be a short-term exemption so then they can have time to change their supply chains. But if you listen to the Energy Secretary, it doesn't sound like there's a lot of room for negotiation.
Gonna have to leave it there. Tyler, appreciate your time this afternoon. You got to run because I know you got a big interview coming up with EPA Administrator Lee Zeldin in just a few minutes. That's Tyler Kendall. She's Bloomberg News White House correspondent on location at Carnegie Mellon University in Pittsburgh. Well, we're going to continue with AI because shares of Nvidia and AMD just surging. Nvidia up 4%, as is AMD. AMD, up 6.3% now. This after the company's plan to resume sales of some AI chips in China after securing Washington's assurances that such shipments would get approved. It's a dramatic reversal from the Trump administration's earlier stance on measures designed to limit Beijing's AI ambitions. Ian King is Bloomberg News U.S. semiconductor and networking reporter. He joins us from our Bloomberg newsroom and bureau in San Francisco. Ian, what is this reversal? The news crossing late last night, obviously good for shareholders who are long these companies. What was the reversal?
Yeah, I mean, in a broader sense, the trend for these companies has been sort of bad to worse, which means, access to their largest potential market, China, has been becoming tighter and tighter, and it's becoming more difficult for them to do business. What they were told was, and this is the U.S. Commerce Department, was actually, look, these licenses, these applications that you've put in for permission to ship some of these chips to China, guess what? We're going to take a positive look at them. So this was really kind of a pleasant surprise if you're a shareholder, where the expectation has been that this situation was going to get worse and worse.
A pleasant surprise and somewhat of an about face, right, when it comes to the presidential administration's policies here. What does this about face really signal about the negotiations going on between China and the U.S. when it comes to semis?
Yeah, I mean, I think you nailed it in terms of negotiations, because as we've seen from senior administration officials who've been on our TV and been on other media sort of talking about this issue today, they've said, oh yeah, we sort of made this deal a while ago when we were asking the Chinese to give us access to rare earth minerals and magnets, and we sort of told them that this might be a thing. So what we're kind of learning here is it's clearly a quid pro quo type situation, and obviously implies that going forward, if we're going to see more of these trade type deals, then perhaps AI exports to China are on the table in a way that we thought they perhaps weren't.
At issue are these H20 chips. You mentioned different officials on our air. One of those officials, Treasury Secretary Scott Bessent, he was on Bloomberg Surveillance a little earlier today. Here's what he said about those Nvidia H20 chips.
Be a judgment that the Chinese indigenous manufacturers already have an equivalent chip. So, if there's an equivalent chip, then the Nvidia H20 could be sold. One thing that we do not want is a digital Belt and Road springing up around the world because other countries or China are substituting for our American chip manufacturers.
That was Treasury Secretary Scott Bessent on Bloomberg Surveillance earlier. I'll repeat a little bit of what he said. He does not want a digital Belt and Road springing up around the world. That, of course, referring to what China's been able to do physically around the world when it comes to trade, when it comes to ports, when it comes to building roads throughout the entire world, or almost the entire world, much of the developing world, I should say, and exerting its own influence on countries around the world that way. Is there already a digital Belt and Road initiative that China has been exerting on the rest of the world, Ian?
In this particular area, in AI, not yet. But what Jensen Huang, the CEO of Nvidia, has argued, and some of his peers have argued, is like, look, if you don't let the US technology become the absolute center, the base layer of this giant AI build out around the world, somebody else will. Who will that somebody be? Most likely China. Right now, they're not as good as we are. Right now, they're way behind us. But guess what? If you give them the chance, they'll catch us up. That's been the kind of, hey, you need to let us be out there and propagate our AI kind of argument that they've made. And this is clearly something that we've seen administration officials kind of parrot or adopt, if you like, in terms of their explanation of why they're going to let Nvidia and AMD sort of play in China to a greater extent than we thought they would.
I'm wondering how this development, well, I guess what it means for U.S. tech and AI companies now versus companies, I'm thinking DeepSeek in China, that are also trying to kind of get ahead in the AI arms race. Does this level the playing field?
No, it doesn't. I mean, you know, it's still a very distorted, if you like, situation. US companies are not going to be allowed to sort of absolute free access. You know, the US administration officials were very clear to point out that, hey, we're only letting them have these access to these older chips, right? That nothing new, nothing state-of-the-art is going to be allowed there. So those Chinese companies that are actually developing, they will have access to some, perhaps US technology, but nothing state-of-the-art. So they've kind of got to make their own way still, and that's obviously a hard road.
How are they doing in that?
It depends who you speak to. Those that want to argue for more freedom, that want to argue that the US is at risk, are saying the Chinese are finding a way. Huawei's doing really well. DeepSeek is doing really well, and they're making do and mend with very little. So guess what? If they, over time, they're going to get better. Others are saying, no, they're way behind us here. This is our chance to really hold them back, and the US is forging ahead. So, you know, the argument tends to shift according to who's making it and what the motivations are. What the reality is will be determined by the market and the use of these systems worldwide.
Ian, just 10 seconds on sort of the next question when it comes to what Nvidia and AMD and the like cannot still export. What is it?
Yeah, I mean, the next question is how many of these licenses are they going to get, and what does that mean materially for them? And the answer is we don't really know yet how quickly these licenses will come, how quickly they'll be able to ship, and how much demand there'll be, whether it'll restore the lost revenue that they've already had to point to.
Well, there's certainly demand for shares of these companies today. Nvidia up 4%, AMD up 6.4%. Ian King, Bloomberg News, U.S. Semiconductor and Networking reporter. Always love it when you join us on Bloomberg Business Week Daily. Coming up next, we're talking BlackRock earnings.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Little change right now for the S&P 500 index. Down a point, down less than 0.1%, 62.67. At one point this morning, we did have the S&P rally to 6,300 briefly. The Dow now down 306, drop there of 0.1%. But chip news out of China helping send NASDAQ and the NASDAQ 100 index higher. Right now, NASDAQ is up 132 points, up 0.6%. We've got the NASDAQ 100 index up by 0.5%. NASDAQ, by the way, trading at a record. Our Mag 7 index up now by 1%. The 10-year, 4.48%. CPI Tuesday with the 2-year, 3.95%. And the 30-year at 5.01%. Gold now down 0.4%, 33.29 the ounce. And West Texas Intermediate crude down 0.5%, 66.62 a barrel. Nvidia and AMD plan to resume resumed sales of some AI chips in China after securing Washington's assurances that such shipments will get approved. Nvidia right now up 3.9%. Advanced Micro Devices up by 6.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you, Charlie. Well, those are the indexes, but when it comes to the individual stocks, one of the worst performers right now in the S&P 500 is BlackRock. After hitting a record high on Monday, the world's largest asset manager is now down about 5% today, headed for its worst earnings day drop in more than a decade. This after revenue and performance fees missed estimates in the latest earnings report. Total assets, however, hit a record $12.5 trillion as the company continues to grow its ETF business and expand into private markets. Again, this is an asset management giant here. Kathy Seifert is director at CFRA Research. She joins us from New Jersey to talk all things BlackRock earnings. Kathy, let's just get your high-level thoughts here on the price action that we're seeing right now. Why are investors so bearish on BlackRock today?
Sure. I think we can break it down into three main areas. The first is there was a large client redemption in the quarter, a $52 billion client redemption from one client. I think that spooked investors. Redemptions tend to do that. And that masks some otherwise really good fund flow trends. The second thing I think that also spooked investors, because the entire group is off today, was the higher than expected inflation number, particularly as we're likely to head into a summer where tariffs are going to probably potentially boost that number higher. And, long dated assets and highly correlated assets like those at BlackRock are vulnerable. Stocks are vulnerable to a correction when that happens. And then I think the third factor that drove today's performance was, for lack of a better word, the noise around all of the acquisitions that BlackRock has done. Having said all that, I am still positive on the shares.
It's the world's largest money manager. It's certainly known over the last couple of decades for the growth that it's seen when it comes to ETFs. And that's certainly Emily Grafeo's specialty in her coverage here as a cross-asset reporter. But BlackRock is going through this transformation right now. Private markets, infrastructure. What is its identity? And how has it communicated that to investors?
That's a really good question, because I think some of the shortfall today may have been investors sort of digesting all these changes, and also some of the execution risk inherent in that strategy. I mean, I do like the strategy, and I think BlackRock has these sort of three pillars of growth. One is the ETFs, as you mentioned. The other is their technology business, which is there is a secular shift among a lot of in the asset management space that's driving demand for BlackRock's technology services. And then the third leg to this strategy, which I think, to your point, that perhaps BlackRock needs to perhaps be a little more granular in the strategy, maybe highlight or elevate some of the people driving the strategy. And that is their shift into private assets and alternative assets. I think it's an important shift for BlackRock, and I think it's one that'll offer support to the share's valuation. But I think it's one that has, number one, some execution risk, and number two, is likely to make 2025 a transitional year for the firm.
Talk a little bit more about BlackRock's push here into private markets. Just how critical is it that they get this right? And the earnings that we've seen so far, this report today, did it tell us anything about how successful this push into alternatives has been so far?
Sure. And so, one of the challenges, given BlackRock's size, moving the needle is going to be a challenge. That's number one. I mean, we saw the AUM number, $12.5 trillion. A lot of it is in ETFs or in institutionally managed assets. And so the push to alternatives is likely to take some time. I mean, BlackRock's aspirational goal is to have 30% of revenues coming from technology and alternatives by 2030. It's about, last year, I think it was about 14 or 15%. So, we can sort of hang our hat on that number. I think the other thing to remember is this strategy, and I applaud this strategy. I do think it makes a lot of sense. They have sort of, and I'm going to say cobbled together, and there shouldn't be a negative connotation with that. They've sort of assembled a group of companies and built themselves a pipeline through which they will be able to push more product. And by that, I mean buying global infrastructure partners gives them exposure to infrastructure. HPS gives them exposure to private credit. Those are very important because the demand for both of those assets is expected to continue to grow, particularly among institutional pension funds, life insurance companies. That's a secular shift, and it's an important part of the market. And I applaud the fact that BlackRock is expanding its reach in that area.
I have to get an ETF question in here because, like Tim said, this is part of my focus on the cross-asset team at Bloomberg News. So BlackRock has more total ETF assets than Vanguard. But when it comes to flows, Vanguard has taken in more ETF inflows for the last 5 years than BlackRock. And I'm wondering if you think this is something that keeps Larry Fink up at night, this potential that Vanguard is going to overtake BlackRock in total ETF assets. Is this something that is important to BlackRock? And is it something that you're watching?
Well, I mean, definitely. I think the ETF marketplace represents BlackRock's ETF franchise is an attractive franchise, but I think growth there is going to be a challenge. I mean, the market, they're the leader. I would also point out, though, that BlackRock's lineup of ETFs has a greater representation in some of the faster growing areas. Digital assets and things, alternatives, things like that. So while perhaps overall flows at Vanguard may be more than at BlackRock, they're flowing into some very low fee generating businesses. And one of the strategies at BlackRock is to have a shift to assets that generate a greater revenues or, a higher fee earning assets. So I think the focus at BlackRock is to obviously maintain their dominance in the ETF market space, continue to innovate there, which they have done, but at the same time push into areas where there still is a degree of, let's just say, pricing power on the part of the asset manager.
Hey, just 30 seconds, 20 seconds on its identity. If we think about peers out there, Vanguard's certainly one that Emily thinks a lot about. What about like a Capital Group? What are the other companies that you think are, or maybe an Apollo these days? Like, what is a peer now to BlackRock?
Well, that's interesting because I sort of would put, if you look at, again, I'm an equity analyst, and so my primary focus in terms of valuation is on the other publicly traded asset managers, and it's a very bifurcated group.
Right.
If you look at the way for example, the way S&P classifies the asset management group, on one end of the spectrum in terms of valuation, you have the private equity firms, Blackstone, KKR, and Apollo. Sort of sitting right in the middle of that, you have BlackRock. And then at the other end of the spectrum, BlackRock with, primarily a traditional asset manager shifting. And then at the other end of the spectrum, you have a number of the primarily active managers.
Yeah. Hey, Kathy Seifert at CFRA, thanks so much.
You're listening to Bloomberg Business Week Daily with Carol Massar and Tim Stenivek on Bloomberg Radio and Television.
It is Bloomberg Business Week Daily. That is Emily Graffeo, Bloomberg News cross-asset reporter. She's in for Carol Massar this afternoon. I'm Tim Stenivek. We're not seeing a lot of action in the S&P 500 today. Down 0.1%. The Dow down 0.8%. The NASDAQ is higher by 0.5 percentage point. That's kind of thanks to AMD and Nvidia. Shares just surging today on that news that we got late yesterday about those export restrictions being lifted and optimism there. What's on your radar today?
Well, I'm looking at Treasury yields right now because after the inflation print, we really didn't see that much movement in the rate space. And now we're seeing yields climbing even after the core, at least the core number came in below expectations. So that piqued my interest. But Let's take a look at some stocks on the move today. With us is Bloomberg News equities reporter Nora Melinda. I'm Emily Griffeo, here with Tim Stenovic. Nora, what are you looking at?
Well, let's take a look at Newmont. This is ticker NEM, and this is a precious metals company. Market cap is about $63 billion, and they're based in Denver, Colorado. We're seeing shares that are lower this afternoon. We're seeing shares that are down about 6%. This is after market close yesterday. They said that their CFO, Kathy Ovalman, was going to be resigning from her role. We have Peter Wexler coming in as interim CFO rather. But this is until a permanent successor is named, and they weren't really expecting this. This was definitely a surprise. That's what much of the street is saying. BMO analysts writing that we are somewhat surprised that she'd only been in the role for about 2 years. But they do know that the average tenure of a S&P 500 CFO was around 5 years. So this was definitely a stark, surprising departure here.
July 24th is when we'll get second quarter results from Newmont. So keep an eye out for those in just about a couple of weeks. Newmont shares, ticker NEM, are lower on this Tuesday. What else are you watching?
Also looking at Trade Desk, that's ticker TTD, and we're seeing shares that are rallying right now. It's a $39.9 billion market cap company. It's an online advertising firm. It's hitting its highest level since February, and this is after it was added to the S&P 500. It'll be added ahead of trading on July 18th. They're saying that this inclusion is an additional confirmation of Trade Desk's very impressive fundamentals that's coming from Evercore analysts today. So we are seeing shares pairing a little bit, but definitely still pointing higher, up about 7.8% right now as we speak. But if you look on a broader scale, companies down about 31% so far this year.
But still index inclusion.
Yeah, still index inclusion.
Okay.
So interesting.
You never really know how they make.
Can you explain this, Emily?
The significance.
And like the optimism around this? It has to do with, okay, well now funds have to buy this stock, right?
Right. Visibility.
Yeah. So there's like billions of dollars, it might even be trillions of dollars now, that track the S&P 500 through various index funds. And so what happens is once it's announced that a company is going to be added, there's a little bit of time between the announcement and when all of those big passive funds have to buy.
Absolutely.
And so in that interim period, hedge funds buy it, anticipating that it's going to go up. And so there's a little bit of like an index arbitrage trade going on.
We'll see if there's some movement.
And anticipation of big buying later on. There's buying now.
Well, we can't talk about stock movers without talking about all that's going on in the banking space. We know that earnings really kicked off this morning. So I'm looking at shares of Wells Fargo. It's among one of the worst performing stocks in the S&P 500. I'm actually looking at the KBW Bank Index. That's ticker BKX. And it's down about 2% right now. And we're seeing Wells Fargo and State Street, some of the worst performing stocks in that index. But Wells Fargo, ticker WFC, is lower after reporting net interest income for the second quarter that missed the average analyst estimate. It lowered its full year guidance for net income. Net interest income after another quarter of tepid growth. So they're saying that a lot of this lowered guidance will be on the mind of the market, with the shares under pressure today, especially after rallying over the past month. So seeing the stock taking a bit of a breather right now. But when you do put that against some of the other results we got from like Citigroup, for instance, that's one of the best performing stocks right now in that banking index. It's rising to its highest level since 2008.
That's
after
wild.
Insane, right? The comparison here, it's saying that it would ramp up stock buybacks following a strong result in the regulatory stress test that we all have kind of been following here. So
Wells Fargo, WFC US down about 6%. JPMorgan reported earlier today down about 0.9%. And Citi, as you mentioned, highest since 2008, up 4.2% as we speak.
On a tear.
It makes tomorrow even more exciting,
right?
Because there's not a consensus of like, how are all the banks doing? We've seen this bifurcation.
So Bank of America, Morgan Stanley, Goldman Sachs, if we look forward a little bit.
Most definitely.
Those are the big ones.
Okay. Nora Melinda, thank you so much. She's Bloomberg News equities reporter on today's Stock Movers. For more conversations like this, listen to our new Stock Movers podcast. You can subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Taking a look at how stocks are looking right now, seeing a little bit of a leg lower on the S&P 500, down 0.2%. The Dow down 0.9%, while the NASDAQ is in the green, up 0.4%. If you are sticking with us on Bloomberg Business Week Daily, We've got a great program coming up on radio, YouTube, and Bloomberg Originals. We're going to be speaking about today's big take. It's all about the quiet revolution that's happening at Vanguard. Also, a check on the global market for insurance, commercial insurance protection. We're going to be speaking with the CEO of Axis Capital Holdings. It's a $9 billion market cap company, publicly traded here in the U.S. And we'll also hear from Donald Trump Jr.